Imagine a construction company that just sold more apartments than ever before in its history. Every unit, gone. Waiting lists, record demand. And at the end of the year, the checking account had less money in it than when the year began. That's not a hypothetical. That's the quarter we're about to open. Second quarter, 2026. Tesla. Record deliveries for a second quarter. 480,000 vehicles. Revenue crossing $100 billion on a trailing 12-month basis for the first time ever. $28,236 million in the quarter alone, up 26% from a year ago. On paper, this is the best quarter this company has had in its history. Here's the question that headline never answers. Of those $5.8 billion in new revenue, how much of it actually became profit? Total revenue grew by nearly $5.9 billion quarter over quarter. Total gross profit grew by 31 million. 31 million out of 5,900,000,000. That's not a rounding error. That's less than 1% of the new revenue turning into gross profit. The building sold more units than ever. The money from those sales almost didn't stay in the account. So if the extra revenue didn't become profit, where did it go? The company's own report tells you in its own words. Operating expenses rose, driven by AI and other R&D projects. Research and development alone jumped $425 million in a single quarter. Total operating expenses up $574 million. Take the $31 million in new gross profit, subtract the $574 million in new operating expenses. That's exactly how operating income fell from $941 million to $398 million. This isn't a company quietly losing its grip. This is a company visibly redirecting where every new dollar goes. Not every part of this business bled the same way. The two segments the company put on its cover page, vehicles and energy, are the two that barely converted their growth into profit. Energy actually lost money on the way up. The one segment that did convert cleanly, services, isn't mentioned as a record anywhere in this report. Keep that in your pocket. It matters later. So the money didn't vanish. This is where the investigation actually pays off, because it moves somewhere specific, and the report names exactly where. Look at what's listed as under construction or commissioning in this same report. A new semi-truck factory in Nevada, a mega factory in Texas, a chip fab in Austin, first-generation robot production lines in Fremont. Capital expenditures jumped 132% in one quarter to $5,789,000,000. Free cash flow, which was positive $1.4 billion in the prior quarter, went negative. $1,092,000,000 underwater. That's the construction company in numbers. 5 towers going up at once, and the checking account feeling every one of them. There's one more piece, because none of this shows up in the net income number the world actually reads. Net income attributable to common stockholders, $1.1 billion, down only 5% from a year ago. Looks stable. But strip out two things the company itself flags as non-recurring. A $763 million unrealized gain from its stake in SpaceX, and a $274 million one-time tax benefit. And the real recurring profit fell 17%, not 5%. The documents don't say the company built the SpaceX gain into its results to hide a weaker quarter, but the timeline is hard to ignore. The one thing propping up the headline number is the one thing that has nothing to do with selling a single car. So, Did Tesla have a bad quarter? That's still the wrong question. The right one is the one this report actually answers. Where did the money go? And the answer is into 5 buildings that don't have tenants yet. Every great construction project looks expensive before the doors open. The report tells us where the money went. It cannot tell us whether those buildings will ever justify what they cost. That's the next chapter.